How to choose the best blue chip stocks, rewritten version. When you're selecting high-quality blue chip stocks, the goal isn't to chase the most exciting or trendy companies. Instead, the real objective is to find businesses that combine long-term durability, steady growth, and reasonable valuation. I'm going to walk you through a practical system you can use to evaluate blue chip stocks step by step. This method focuses on understanding what truly makes a blue chip company worth owning. Step 1. Understand what makes a true blue chip. Before investing in any company, you need to know what qualifies it as a strong blue chip stock. A genuine blue chip company usually has at least 10 years of consistent profitability, strong and reliable free cash flow, a solid investment-grade balance sheet, a competitive advantage that protects its business, a global presence or strong market leadership. However, just because a company is considered a blue chip doesn't automatically mean it's a great investment today. Even excellent companies can become poor investments if their valuation becomes too expensive. That's why it's important to analyze specific financial metrics before making a decision. The 5 core metrics to research. These 5 metrics form the foundation of evaluating any blue chip stock. 1. Revenue growth. The first thing to examine is revenue growth, not just earnings. Look for companies with 5-year revenue, CAGR, compound annual growth rate. Above 5% to 8% revenue growth shows whether a company is truly expanding its business. It proves that demand for its products or services is increasing, rather than growth coming from cost-cutting or accounting adjustments. Healthy revenue growth usually signals long-term strength. 2. Return on invested capital, ROIC. The second key metric is ROIC, which measures how efficiently a company uses its capital. General benchmarks: 15% or higher equals excellent 10% to 15% equals strong IR. OIC usually indicates a strong competitive advantage. Companies with scalable business models often show very strong ROIC numbers because they can grow without needing massive investments. 3. Free cash flow. Growth cash flow is the lifeblood of any business. Strong and growing free cash flow allows companies to pay dividends, buy back shares, invest in innovation, make acquisitions. Many companies fail not because they lack profits, but because they run out of cash. That's why consistent free cash flow growth is one of the most important indicators of financial health. 4. Debt levels. Next, evaluate how much debt the company carries. Focus on debt-to-equity ratio interest coverage. Ratio-strong companies maintain debt levels they can comfortably manage, even during economic downturns. Businesses with balanced debt are more likely to survive recessions without major financial stress. 5. Valuation. Finally, valuation determines whether you're paying too much for a stock. Even great companies can be poor investments if purchased at inflated prices. Key valuation tools include price to earnings, PE, ratio, PEG ratio, PE divided by growth rate. Free cash flow, yield. A strong company bought at a reasonable price usually performs better over time than an excellent company purchased at an extremely high price. Matching companies to economic trends. Once you've reviewed the financial metrics, the next step is to match companies with major economic trends. Different companies perform better under different economic conditions. For example, if you believe technology and artificial intelligence will dominate the future, then technology-focused companies may benefit the most. If you expect market volatility or higher interest rates, businesses with strong cash generation and diversified revenue streams tend to perform better. If you're preparing for a recession, defensive companies that sell essential products often remain stable even when the economy slows down. Understanding the broader economic environment helps you choose the right types of companies for the future. Step 4. The 10-year test. One of the most powerful ways to evaluate a company is to imagine its future. Ask yourself, will this company still dominate its industry in 10 years? Does it have strong brand loyalty or switching costs? Would I feel confident holding this stock during a 30% market drop? If the answer to these questions is yes, then the company may be a strong long-term candidate. Also, it's important to review your portfolio regularly. If you own a stock you no longer believe in, there's no reason to hold it just because it performed well in the past. Common mistakes to avoid. Many investors make similar mistakes when choosing stocks. Avoiding these can significantly improve results. Mistake 1. Buying because it's popular. Never invest in a stock just because it's famous or widely talked about. Always base decisions on research, not popularity. Mistake 2. Chasing recent performance. Just because a stock performed well recently doesn't mean it will continue performing well. Always look at long-term performance, preferably 10 years or more. Mistake 3. Ignoring valuation. Many investors overlook valuation and pay too much for good companies. Remember, today's price matters just as much as the company's quality. Mistake 4. Over-concentrating in one sector. Putting too much money into one industry increases risk. For example, investors heavily invested in one sector may face large losses if that sector declines. Diversification protects your portfolio. Building a simple scorecard. A useful way to compare companies is to create a scorecard using the 5 core metrics. Evaluate each company based on revenue growth, ROIC free cash flow, growth debt levels, valuation. This structured method makes comparisons easier and helps remove emotional decision-making. Understanding what makes strong companies attractive. Some companies stand out because of specific strengths. For example, some businesses dominate fast-growing industries like cloud computing or digital technology. Others generate enormous free cash flow because of strong brand loyalty. Some companies benefit from global payment systems or expanding financial networks. Defensive companies perform well because they provide essential products people always need. Each company has its own strengths, and understanding those strengths helps justify why you own it. The most important mindset for investors. One of the most valuable habits investors can develop is understanding why they own each stock. You should be able to explain how the company generates cash, why its growth is sustainable, whether its valuation makes sense, what competitive advantage protects it. If you can clearly explain these factors, you're more likely to stay confident during market downturns. A simple portfolio strategy. If you're just starting, here's an easy way to build a diversified portfolio. Choose 4 to 5 different sectors. Select 1 to 3 strong blue-chip stocks from each sector. This approach spreads risk across industries and reduces dependence on any single company. Another simple alternative is investing in a broad market ETF, which automatically provides exposure to hundreds of companies across multiple sectors. Final thought: successful investing isn't about finding the most exciting company. It's about consistently choosing strong businesses with solid fundamentals, manageable debt, growing cash flow, and reasonable valuations. When you combine smart research with patience and discipline, investing becomes simpler and far more effective over the long term.